All right, in our last video, we told you that buying multifamily is a waste of time, and we're putting our money where our mouth is. So I'm here with Dave Codre of Greenleaf out of Atlanta. And we're under contract on this 100,000 square foot flex space at Friars Crossing in Chattanooga, Tennessee. And today, we're gonna walk you through the property and show you exactly why we're buying this type of property today instead of touching anything multifamily. So flex space has been pretty popular for probably 10, 15 years now, but it wasn't really, I guess, popularized in the mainstream until the last, I would say 4 or 5 years. But you guys actually started looking into this asset class in 2018, give or take, right?
Correct. Yeah, we've been looking at these types of buildings for a while, but it always started with what's a deal that we can operate. We can convert this easily to, different layouts, add doors as needed. It really fits that definition of flex.
Yeah.
Whereas the other stuff, if you've got tilt-up walls or you have metal buildings, they're not really flex.
Yeah, I mean, the nice thing about flex space is that it is actually the most versatile type of commercial real estate that you can really find. But I mean, you can tell with the tenant mix that we've got here, I mean, we've got a hearing center, we've got State Farm, we've got Tower Community Financial Group. I mean, it's kind of a wide variety of office and professional services. When you do multifamily or you do office, generally you're restricted to one asset type. And I believe, and I know that this is y'all's investment philosophy as well, diversification is the name of the game. And this asset class really allows for that because you get a wide variety of tenants, you get a wide variety of uses.
And the smaller tenant suites, it really enables us to get to a yes quicker.
Right.
Like a lot of times commercial space, your biggest risk is just long-term vacancy. If you can fix that by how do you get to a yes with a tenant that wants to move in, wants to use the space, it makes the deal that much better.
So Dave, I mean, you guys have been converting a lot of office space, 1 and 2 story in the Atlanta area into flex buildings like this. So when you see these types of buildings, this type of construction, what stands out to you immediately in terms of what could be done or what should be done?
The biggest benefit is we have an easy way to divide up things into specific suites, right? So we don't have this one giant span. All of the window columns here, if you kind of just envision looking at that window, you could convert that into a roll-up door, and then it can roll up and it'll look really nice. So you can have an entrance right next to it with a roll-up door going in, so you can really customize the space that you need that's best for your business.
So Dave, your strategy has always been buy something that you can add value to. What's the value add play here?
The value add comes from how can you position the asset for when there is turnover, they want to stay, they want to be there, they're willing to pay higher or even up to market rents. Let's lease all of the space.
Right.
Find a way that we can do that. And that's really where we see something like this that is well occupied, but we have a few tenants that are lower on their rents and we have some vacancy. It's like, let's go in and lease all that space. On the commercial side, it's a little bit more of a partnership with these tenants. We want to make sure we can control our operating expenses, control our tax costs, insurance costs. We want to do the best we can because a lot of those costs do pass through to the tenant on our common area maintenance. So we really got to work with them to figure out what's the most efficient way we can operate this. Yeah, most of these companies that are operating here, it's like rent is not 30 to 40% of their costs like it is in the residential segment, but they would also like for it to be as affordable as they can. It's more of a line item expense, so we want it to be as effectively priced as possible.
Yeah. One of the biggest transitions going from multifamily to commercial is the tenant base. So, I mean, how has that experience been moving from dealing mostly with residential tenants to mostly commercial now?
It's really a personality difference and a conversation difference, right? Like the residential side is there's a lot of emotion tied to where are you going to live and what is your living experience going to be like. And while that on the commercial side, it's much more of like a logical conversation.
Right.
As to what do the rates look like here, what services, what amenities do we have, what's the power supply that's coming in. You kind of have this checklist of requirements that has to happen on the commercial side. And if you fulfill that, and it's a good price, now you have a tenant.
How do you go about choosing the right leasing team when you're getting into a project like this?
A lot of the times tenants also have a broker on their side that's helping them identify that right space. And then on our side, we have our team in-house that's making sure that we can do all the tours, we can get everyone in, we can make it easy for them, we can get them all of the information quickly so they can make a decision. Because they're making a 3 to 5 year commitment.
And so are we as a landlord, right? I mean, we're also making that 3 to 5 year commitment, and so it's very important that you look at how many locations do they have? Do they have any references? 2 to 3 years of tax returns.
So the main thing we're gonna do looking down this corridor is we're gonna put on the vertical access doors on the front, right? So they'll look the same, they'll be glass paneled, they'll have the same kind of trim in them, but this gives the tenants an opportunity to go in a main door like an office, and right next to that, have a large garage door that also goes up so they can get all their equipment in and out.
Outside of that, there's not a lot of physical upgrades that you have to do. How much do you guys budget for that typically?
It typically costs us about $6 to $7 a square foot to get stuff out of a space. So that's how do we get it down to like standard walls, concrete floor. You got to replace the carpet just like in multifamily. Right. And then from there, we're going to be about 15 to 20 bucks a square foot to go build back what needs to be in there.
Is that something that you guys look at whenever you're coming into a building like this? Like, should we make the entrances a little more uniform?
Most of that stuff was done like aesthetically when they designed these things. Yep. So it's not really a big selling point for a tenant that's coming into a space.
Yeah, a lot of landlords get that wrong. I mean, they think, especially first-time commercial real estate investors, like, oh, I want to make the place super pretty. And they overspend, and tenants aren't willing to pay you extra money just because you're doing a nice chandelier in the front.
As long as everything's clean, well lit, and I can get around the property, I'm normally pretty happy.
So this is the one vacancy that we've got right now, what, about 2,000 square feet?
Yeah.
This will be the first one that will get upgraded. So let's take a look at this one first.
So this is what a vacant suite looks like. It doesn't look that bad. However, we've got layers of floor here, just like you'd have in multifamily, where you have layers of carpet. We'll clean all that stuff up, and then you've got pretty old drop ceilings that if you take one of these spaces and get rid of this kind of 8.5, 9 foot drop ceiling, and you raise it up to the 14 feet that's here, it looks a lot nicer. And this one, we've got some rooms on the other side here where you're going into your offices and conference room stuff. And then this, a lot of times, when we're looking at coming in space, you need to be coming in and there needs to be 1, 2 offices in a conference room. They need to be efficiently laid out so you have as much open storage space as possible.
That's right.
In a lot of these, they all have concrete floors. So one part that is tricky is if you're trying to move plumbing and you got to cut through the concrete, it can get expensive. Right? So you're really looking at when you're buying a building like this suite right here, it has 2 bathrooms already laid out. It already has the water for a small kitchen area. It's just kind of like all dingy and contained, but we at least don't have to trench anything and cut through the concrete.
It's staying right here.
It's all staying right here. We leave the concrete floor that's there, and it's a mix.
So easy to maintain tenant after tenant.
Yes.
You had mentioned the power.
The more, the better.
Yeah.
No tenant ever says like, man, I wish there was less power in here.
Yeah, we've got 3-phase on both of these, 400 amps, 250 amps on this one. I mean, you could open up a woodworking facility in here and run pretty much any piece of equipment that you'd want to.
Yeah, but you just look at it from here. This could be a big suite that would be highly usable. Even for the most part, I mean, we raise this ceiling up, we're just putting in the hang down pendant lights. Yeah. Really opens everything up. Yes, we've got a lot of these where we have generators that power an entire building that's in there. If anything goes out, it's there. It's most likely put in from a prior tenant, and we'll pick up the service agreements on these things and maintain them. And then you've got backup power, which is a nice benefit for anyone that does occupy the space. But you can see here, this one, this building, it has a ton of roll-up doors already put in, but they're all the metal ones. They don't look as nice as putting in some glass stuff.
But it's the back of the building.
Mostly all of our success in leasing comes from, if we do have big tenants, they are great and they do work, but if they do vacate, we're normally looking to downsize those, divide up the suites into smaller footprints, and then lease those. We can lease those a lot faster.
Yeah.
But this is one of the fun parts of doing this stuff. You get to come up and see actually what's happening and figure out what you can do on an asset. But typically when I'm coming up here, I'm like, do I see any standing water? We got a little bit of standing water. That's maybe just has to be sloped right or something with the roofing here. But we're looking at the HVAC systems, and that comes into the lease of whose responsibility is the HVAC system. Is it the tenants or is it the landlord's responsibility? A lot of times with these bigger tenants, it's their responsibility.
Well, while we're up here, I think it's an appropriate time to talk about maintenance. There's a pretty common misconception in commercial real estate that tenants maintain everything. Tenants do everything. Right, and that's why we get into commercial real estate, because we as landlords don't have to do anything at all. It makes it very easy.
That has not been the case in my experience.
Pretty nice if it was.
Yeah, it would be. But we're looking at this stuff of like, how can we use a team that can manage multiple assets? So there's got to be some similarities in how we get stuff done. But the commercial side, that's why we want to be buying 1-story buildings. that we can actually work on with our existing team. The tenants are never just like, hey, we do everything.
Or even if the tenant is technically 100% responsible for everything, they're probably still paying the landlord who's then paying the property taxes. When you look at an asset like this, I mean, what are your thoughts when it comes to maintenance?
When I'm thinking about maintenance, I'm thinking about accessibility and skill sets. We want to be able to do stuff quickly, keep our tenants happy, and get stuff fixed. So we're looking for assets that we can actually maintain. A lot of these systems, if we look at this, they're not overly complex, and it's not only just a landlord decision.
Right.
Like a lot of times this right here, there could be shared expense ratios, there could be offset costs with tenants, and once they hit certain thresholds of costs, we really got to review the lease and then talk with the tenant, be like, hey, what's the best decision here for both of us to make sure we do this as most efficiently as possible.
All right, we are back here in the office, and we're going to be diving into the offering memorandum for the Friars Flex deal in Chattanooga. So I'm going to hand it over to Dave, since he and his team put this beautiful document together for us.
Thanks, Tyler. Excited to be talking about this one here. You know, we put together our presentations. We try and keep them consistent, so it's easy to find out where is the information and what's critical when you're looking at a deal. Anytime we go through a project, we always want to outline like what has to go well for this deal to work, where are the risks, and then ultimately, how are the LPs and how are the GPs in the deal getting paid to make sure that that incentive package is really aligned to have the best outcome in any real estate project.
That's exactly right. The offering memorandum is basically the business plan for what you are going to be doing on the project.
So one of the slides to us that's most important, when we look at this sales comparables, you know, there's two things we look at. A lot of times people are just looking at what is an exit price you could get for the deal, but it's also when have things like this transacted? Some of our sales comps that we have in here, you can see it's been over multiple years, so like 22, 23, 24. And the reason is there are just not a lot of buildings like this that transact. They're hard to find. They're fairly rare in what's coming up and available in the marketplace. And a lot of times these deals also trade when it's an owner occupant. There's a whole different financing packages that are available if you buy an occupied building on your own. So the sizes vary. When we look at Friars, it's really 3 buildings of various square footage. A lot of our comps that have traded over the past few years are in that $130, $140, $150 a square foot range, which we're buying our deal just over $100 a square foot. So we really like the basis of where we're at going in. And this shows us when we look at that, there's a lot of upside just in the pricing that's in the market, but there's also just not a whole lot of transaction volume because a lot of these deals don't come to market that often. So when we're looking at sales comps, we're seeing, okay, we want to know how many have transacted. We also want to know what that price is. And here it shows we've got a lot of good upside potential as we get this deal stable.
That's exactly right. I mean, the nice thing about having a building of this size, or a property of this size rather, with 3 buildings is that it gives you multiple exit options as well, right? We could sell it as one building. If we have to, we could also break it up into 3 smaller buildings and get a premium on the price per square foot on that sale as well.
Yeah, we're doing another deal in Chattanooga that we've owned for a while that we have, again, same thing, sold individual parcels of a larger asset. A lot of times that is the exit strategy that's associated with a multi-building deal. On top of this, when we go into starting to look at like what does the LP and the GP splits look like? So you want to understand when underwriting any of these deals, how does the money flow? How does everyone get paid on a transactions like this? And ultimately, from the investor standpoint, you want to know, hey, what are my risks and what am I looking for financially? So let's jump ahead to the investment one. And here we got a couple different points on this. Right, we want to know what are we paying for a deal, what's going into it on the capital improvement side, and then ultimately what does the incentive and compensation package look like. So Friars, we're paying just over $10 million for this deal. We have over $1 million of CapEx. A lot of that work, I mean, we are 91% occupied, so it's very full, but a lot of that work is going to go into preparing and occupying the remaining space. In CapEx, on our side includes everything from physical improvements of future space to we have a few upgrades we got to do just on current HVAC units and things we want to fix so that the property operates easily. So we have to get that stuff fixed. And it also includes the leasing components on our end as well. Then we see we have reserves and closing costs that come into it. Closing costs, we look at, what are acquisition fees On the Greenleaf side, we charge a 2% acquisition fee. We try to put that out here and be very transparent about the fees that we're getting paid. And then also on top of that, we are going to pay a bank closing fee. Banks are typically charging a percentage point on a deal to do the financing for that deal. And then we have brokerage fees as well in the transaction. So all that stuff is clearly outlined here, and then it shows what our total debt and our total equity on this deal looks like to be just over $12 million. When we look at our investment splits and like, okay, we put some money in, how does this deal work? We operate on a what we like to think is a pretty simple format where we have a set preferred return. So that preferred return is essentially accruing, where 7% hurdle every year has to be hit before the general partner earns any money. And that split between the investor profit share is 70%. On the general partner side, it's 30%. So that's where we're trying to be transparent on what does the total capitalization of the deal look like? What do the splits look like? And then we look at where are we now and where do we have to get to? So year one, you can see what our financials look like right there. And you can see we're just below the necessary cash on cash returns needed to pay that preferred return. Our business case is that we fully occupy the space. We achieve just market rents. We're not trying to surpass market rents. We're not trying to add in anything crazy. We just want to be at market, and that will bring our projected NOI just over 1.1 million. It gets us up over our preferred return cash on cash holder rate, and then ultimately double digits for the annual total investment returns. For us to achieve that by year 3, we're really looking at getting there in the first 12 months. So we want to fully occupy the building, get all the leases in place so that we have a runway of years of strong performance. These deals really work the best or perform the best when we have longer term leases with set terms so we can really forecast how is it going to work. It also creates the most value. We think about that. We cycle back to that sales comp. We want to know things are going to trade at the best value when they have good leases with longer terms. And that's where we'll see a stronger exit price that is based on these leases. So that's really what we're focused on the business plan here is get in, do our necessary repairs, get our leases signed so it is full with the longest WALT or weighted average lease term that we can get. And that's where we really unlock the true potential of this deal. So we're excited about it. And we'll be able to get to double-digit investment returns pretty quickly in the grand scheme of things on a real estate deal. And yeah, we're excited to get started on this one.
So there you have it for why we're buying flex space instead of apartments these days. If you're interested in investing in this deal with us, click the link in the description below. Give us a call. Let's have a conversation about it. If you want to learn more about flex space and why investing in this product just makes sense today, check out this video next.